called semantic investing is going on now with ETFs and indexation. And I'll explain it more later, but I think I have to start with this. And I'm going to refresh my memory. So we'll start with the NASDAQ 100, okay? QQQ is the ticker for one way to get a hold of this. And it's got $50 billion in assets. So we know what this is. Now, active management versus passive. So in active management, if people don't want active management, the idea is that your returns are in large measure determined by individual security selection. The idea in passive management is you're more diversified as to security-specific risk, and security selection should not be impacting your returns. You want to buy the entire market, you want exposure to the market, that's what you get S&P 500. You want exposure to a sector, even. REITs. At least you get exposure to the entire sector, and it's not going to be dominated by whether one particular company does well or not. That's what you're buying in part. Okay. So for people who don't know, when they buy QQQ, the NASDAQ 100, they probably don't know that 41% of the whole weight of all the money in the QQQ is in 1, 2, 3, 4, 5 stocks. Okay, that's Apple, Google, Microsoft, Amazon, and Facebook. Mm-hmm. That's number one. So number one, you've got 41% exposure. Now, as an active manager, I would be sanctioned if I had 40% exposure to one sector. And in fact, in certain jurisdictions, like the European community, there are UCITS funds, like mutual funds, which prohibit a fund from having more than 40% in any series of stocks with 5% or greater weighting. And the UCITS version of QQQ, which trades and has over $1 billion in it, actually has over 41%. So apparently it's okay for an index to violate certain norms that it's not okay for an individual manager to do, or an active manager. Okay.